Welcome to HouseLuxe Estate, where we empower you with the knowledge to make informed decisions about your investments. We're your guide in the vast world of wealth creation. And today, we're venturing into the realm of index funds, specifically how to leverage them in bear markets. This strategy can be a game changer for your portfolio, helping you navigate the stormy seas of financial downturns with confidence. Stay tuned as we delve into the nitty-gritty of leveraging index funds in bear markets. Firstly, we need to understand what index funds are. Index funds are a type of mutual fund with a portfolio constructed to match or track the components of a financial market index. An index is essentially a group of stocks representing a particular segment of the market. For instance, the S&P 500 is a popular index that includes 500 of the largest U.S. companies. Index funds are designed to mirror the performance of these market indices. So, if the S&P 500 goes up by 2%, an index fund based on it would also aim to increase by the same percentage. Now, you might be wondering, why would anyone want to just match the market? Well, that's because historically, the market as a whole has tended to go up over time. Sure, there are periods of downturns, but if you're in it for the long haul, the overall trend has been upward. This brings us to the benefits of investing in index funds. One of the main advantages is diversification. Because index funds hold many different stocks, they spread out the risk. If one company doesn't perform well, it's balanced out by others that do. Another benefit is the low costs. Unlike actively managed funds, where fund managers are constantly buying and selling stocks to try to beat the market, index funds are passively managed. They simply follow the index they're tracking. This means they have lower transaction costs and, as a result, lower fees for investors. Index funds are also transparent. You know exactly what's in the fund because it's based on a public market index. And because they're so straightforward, they're a good choice for beginners who are just dipping their toes into the investment world. In summary, index funds are a type of investment that tracks a market index, offering diversification, low costs, and transparency. They're a solid choice for anyone looking to get a piece of the market's overall growth over time. Now that we have a good grasp of what index funds are, let's move to the next phase. You might have heard the term bear market thrown around, but what does it really mean? A bear market refers to a condition in the stock market where securities prices fall 20% or more from recent highs amid widespread pessimism and negative investor sentiment. This downturn, which typically lasts for at least 2 months, is a regular part of the economic cycle. For instance, during the global financial crisis of 2008, we witnessed a prolonged bear market. But bear markets aren't just about falling prices. They're characterized by investor fear and uncertainty, lower trading volumes, and increased volatility. It's like winter in the world of investing. Just as nature takes a breather before spring, a bear market is a time of retrenchment, correction, and preparation for the next growth phase. With this understanding, we can now discuss how to leverage index funds in such a market. Now we get to the heart of the matter, how to leverage index funds in a bear market. So you've heard about index funds. You've understood what a bear market is. Now, how do you combine these two concepts to help you navigate a bear market effectively? Well, the answer lies in the utilization of 3 key strategies: diversification, long-term investing, and a method known as dollar cost averaging. Let's begin with diversification. Diversification, in the world of investing, is a risk management strategy that involves spreading your investments across various financial instruments, industries, and other categories. It aims to maximize returns by investing in different areas that would each react differently to the same event. So how does diversification work with index funds in a bear market? Well, index funds are inherently diversified. They represent a broad cross-section of the market, and as such, they spread out the risk. In a bear market, individual stocks can plummet dramatically. However, because an index fund holds a wide variety of stocks, the impact of 1 or 2 stocks plummeting is lessened. It's like putting your eggs in different baskets. If one basket falls, you still have eggs in others. Next, let's talk about long-term investing. Bear markets, for all their doom and gloom, are typically short-lived. On average, they last about 1 to 2 years, while bull markets, periods when prices are rising, can last 4 to 5 years. The strategy here is to remain invested for the long term. Index funds, due to their inherent diversification, are well suited for this strategy. They allow you to weather the storm of a bear market and reap the rewards when the market eventually recovers. It's like planting a tree. You don't just plant a seed and expect a tree the next day. You have to water it, tend to it, and give it time to grow. Similarly, investing is a long-term game, particularly when leveraging index funds in bear markets. Finally, we come to dollar cost averaging. This is an investment technique where you consistently invest a fixed amount of money at regular intervals, regardless of the price of the investment. This strategy can be especially useful in a bear market, where prices are generally falling. By regularly investing a set amount in an index fund, you'll buy more shares when prices are low and fewer when prices are high. Over time, this can result in a lower average cost per share compared to making a lump sum investment at a single point in time. Think of it as a sale at your favorite store. When prices drop, you buy more. When they rise, you buy less. In summary, leveraging index funds in a bear market involves a strategic approach that capitalizes on diversification, long-term investing, and dollar cost averaging. These strategies can help mitigate risks and potentially generate substantial returns over time. Remember, investing in a bear market may seem daunting, but with the right strategies, it can be a golden opportunity to grow your wealth. By following these strategies, you can navigate bear markets with ease and confidence. Let's quickly recap what we've learned today. We started off by introducing you to the concept of index funds, a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a financial market index. We highlighted their benefits, including diversification, low operating expenses, and broad market exposure. We moved on to explain the nature of a bear market, a phase where prices in the market are falling, encouraging selling. This is typically a time when the economy is in a downturn, unemployment is on the rise, and several other negative sentiments are prevalent in the market. The core of our discussion, however, focused on how to leverage index funds during these bear markets. We emphasized that bear markets, though daunting, can present opportunities for long-term investors. By maintaining a diversified portfolio through index funds, you can keep your investment strategy on track, even in the face of falling prices. We discussed the importance of staying invested rather than trying to time the market. While it's tempting to pull out of the market during a downturn, history shows that the market has always rebounded over time. By staying invested, you're poised to benefit when the market eventually recovers. We also highlighted the strategy of dollar cost averaging, where you consistently invest a fixed amount in index funds regardless of their price. This approach can help reduce the impact of volatility and lower the average cost per share over time, making it an effective strategy in bear markets. Lastly, we stressed the significance of having a long-term perspective. Bear markets can be challenging, but they are temporary. With patience, resilience, and a well-diversified portfolio of index funds, you can weather the storm and come out stronger. Remember, understanding how to leverage index funds in bear markets is key to maintaining a robust and resilient portfolio. Don't forget to subscribe to House Lux Estate for more insights on investment strategies.